How's it going, guys? Justin here again. Wanted to talk to you today again about real estate. We had a couple videos back talking about some of the three major ways that you make money in real estate. Today we're going to talk about the first one, cash flow, specifically rental. There's a couple variations. I talked about owner finance earlier. Let's keep the focus real simple today, and then we can advance a little bit further later on. And if you have any questions or specific scenarios that you'd like to talk about, you can let me know later. Like I said before, rental income is a very, very old business model. It's been around since feudal times. Literally, kings and lords would rent their lands out to peasants and would make money that way. That's how they worked. In fact, back in the day, it was actually a whole different economic class, and it still kind of is, even though I would say, I feel like the mobility to get into that level is not like it was in feudal times, obviously. So we're going to talk today about specifically analyzing rental properties. How do you evaluate a piece of property in the rental world to have an idea if it's a good investment or not? So I was talking to my cousin earlier today. We were talking about, he was asking me, how do you know it's a good return on investment? And so that term is, it's a very well used term, and I think there's other terms that you need to be aware of and concepts to properly evaluate an investment property, especially how my father and I do it, and how we've taught other people how to do it, so that you can successfully continue stacking your chips. In addition to return on investment, you have NOI, net operating income, as well as capitalization rates. Those are two concepts that you're going to need to know about. Capitalization, cap rate, gets used in multifamily, it's used in a couple other assets, and how you calculate that amount, that value, is slightly different in every asset, but the general concept is the same. You take your gross and you subtract all your expenses out, and you end up with your net. You divide that out from your from what the value of the purchase property, or what you expect to purchase the property at, if you're trying to project what the value of the property is or what the potential value is. And from there, you get your capitalization rate. So return on investment, NOI, net operating income, and capitalization rate. Those are three pretty large concepts that you're going to need to know about. In addition to that, if you're going to finance, this is huge. So this is something that people kind of forget about and don't apply correctly. And it's this idea of cash on cash return. So let's talk about an example. Let's say you have a property that's available for purchase for $100,000. Rental is $1,200 a month. Vacancy rate is, let's say it's like 8.3. So that would be about, so that's one, let's say it's you lose 1 month every year to vacancy costs. And then taxes, let's say they're $2,000 a year on a $100,000 property, 2%. And let's say your insurance is $1,000 a month. Lastly, let's say that your general expenses on the single family property is $1,000 a year. So what that totals out to for your total expenses from this scenario is $4,000 a month. And then vacancy, I like to subtract that out of the gross. You can apply it here if you'd like. It doesn't really matter, as long as you make sure you don't double count. So if you're buying this property cash, gross income, $1,200 a month, you lose 1 month to vacancy, so that's $13,200 a year. So that makes your NOI, your net operating income, $9,200 a year. From there, we can calculate our capitalization rate, which is the $9,200 divided by the potential purchase price. So in this scenario, which would be $100,000. So $9,200 divided by $100,000, we come up with 9.2%, that's great, right? And this is a slightly idealized scenario. In a lot of markets, that's a great deal. Let's be honest. I think anyone would be happy to get that on a cash return. What's even more interesting is if you leverage. This is where people also mess up on the calculation, because I don't even know why people mess up on it. It's just something that I guess just people are never taught. This is more of like the practical math of what comes in, what comes out. And that's what cash on cash return is. Physically, what do you put into it? And physically, what do you take out of it? And what is that percentage? A lot of very successful people have made a lot of money with leveraging and being smart with when to leverage, how to leverage, especially when you're in low risk scenarios like real estate. Real estate, of the different assets that are available to you, this is considered one of the safest vehicles that you can make money. And this is why buyers are able to put 3.5% down and buy $500,000 properties, because it's that stable. Now, okay, so let's paint a leverage scenario. $100,000 property, let's say a typical investment property right now, you're gonna probably need to put 20 to 25% down. Let's say 20% down, and currently as long as the Fed doesn't raise interest rates yet, and they haven't, you can get away with interest rates from 5 to 8%. And let's go in the middle, somewhere in the middle, 6%. And amortize it over 30 years. So in this scenario, your principal and interest would be $479.64 a month. We already included taxes and insurance in your annual, so and I guess when we calculate the annual, I'll include it real quick. So if we annualize this number, that's $5,755.68. So when we group that with the rest of our expenses, that becomes $9,755.68. Now that we have the same gross, but we have the new net expenses, we have a new net income, which is $3,445 and whatever the change is. And we come out with a new NOI. Because now instead of putting $100,000 all to the cash, and not to mention we didn't include closing costs, but let's keep it real simple for now. We only put $20,000 down. So that $34.45 against $20,000, that ends up being 17.225%, which is a lot more than the 9.2 that we were looking at earlier. That's almost double. And how do we do that? We did it with leverage. Not too many people know how to leverage properly, and I want to give it to other people, so that we create other individuals that can get out of the financial rat race and create some financial freedom for themselves. I guess that's kind of my goal. Anyways, guys, if you have any questions about cash flow or cash on cash return, shoot me an email, shoot me a message. My company is texasally.com. Let me know what you think. Thanks.